Initial jobless claims fell to a 4-month low last week, alleviating many people's fears that the labor market was about to experience a recession. Of course, that was at odds with the Federal Reserve's 50 basis point rate cut, which doesn't seem like it's appropriate for an economy that's holding steady or a labor market that's strong and resilient. Not only that, jobless claims is now at odds with another series, the unemployment rate, which those two used to be in lockstep. Because up until recently, jobless claims and the unemployment rate went through cycles together like twins. In fact, the relationship was so close, they provided compelling cyclical proof for trouble in the labor market as recessions developed. So if you saw the unemployment rate go up and jobless claims go up with it, which they always did, that was pretty much the conclusive sign we were in big trouble. But since last year, last September specifically, which keeps coming up over and over again, jobless claims have gone down while the unemployment rate has not only gone up, it's gone up enough that even policymakers at the Federal Reserve, economists, the Psalm rule, and everything else have been triggered. We're now talking about recession when, up until recently, everybody was content to think that we're in a soft landing. So the unemployment rate has changed, and a lot of evidence corroborates the unemployment rate, which leaves us with a big mystery. The government says the labor market is fine, jobless claims, and the government says the labor market is not fine, unemployment rate. So we have a bit of a mystery to unpack there, as well as another one in consumer prices. What's going on with shelter? In the consumer price index, shelter prices accelerated recently, but other BLS data, the new tenant rent index, which we'll get into that in just a minute, that one has actually contracted on a 4-quarter basis for the first time since 2009. So we've got another mystery to unpack in consumer price. We got consumer price mysteries, unemployment mysteries. It's almost like Steve, it's almost like we're talking about the Phillips curve here. We got unemployment and inflation. I feel like an economist already. So let's start with jobless claims. They fell to a 4-month low, but the unemployment rate's going the other direction.
Yeah, even worse, Jeff. We just heard from Fed Chair Jerome Powell, who said, well, he thought that the labor market was coming in balance and that we needed a 50 basis point cut because he raised the target for the unemployment rate. And Jeff, when I saw the 50 basis point cut, I wasn't surprised. We talked about that. We knew this was baked in the cake and was going to happen. But when I saw his projections for the unemployment rate, I'm like, wait a minute, like that doesn't make any sense. If you're saying we need to lower rates to fix the labor market or to keep it in balance or whatever it is that, narrative we need to push, then why didn't we lower him even more so he could bring his projections down? Because what he just said at the press conference is, rate cuts aren't going to do anything to the labor market, which is exactly what you and I have been saying.
Yeah, so the Fed says we need to cut rates, but we don't need to cut rates. I mean, we're so full of contradictions here that it's difficult to really understand where everybody's coming from and what actually is happening. And like I said in the introduction here, the jobless claims and the unemployment rate they used to be, one and the other. You can see this in every single cycle going back a long, long ways. And I'll just show here a couple of different cycles, just going back to the 1990s, because that's enough, or even the 1980s. When the unemployment rate goes up, jobless claims goes up with it. In fact, jobless claims actually go up a little bit before the unemployment rate does. And they were starting to do that last year. The unemployment rate bottomed out around April of 2023. Jobless claims actually bottomed out a little bit earlier and then started to move up a little bit sideways to slightly higher through the middle of last year. And then the unemployment rate in September ticked up. But if you remember last September, same thing as this September, jobless claims went down. So there are a couple of major implications here. One, we have to figure out what's going on. But if you come to the conclusion that jobless claims is just an outlier, then the improvement in September is the same as the improvement last September, which is utterly meaningless. Because ever since last September, more of the economy has looked like the unemployment rate and much less of the economy has looked like jobless claims. So we're left with only a couple different conclusions. Either the unemployment rate is wrong, jobless claims is wrong, or something has happened in the real economy that would change and completely erase the relationship between the two. And it seems like, given all the evidence, Steve, that it's looking like number two here. The jobless claims is just simply an outlier. Something happened with the data series.
Yeah, could it be, Jeff, that maybe we're seeing people lose their jobs who are going on severance, so they can't actually file for unemployment claims, and that this is kind of a deferred reaction that's going to show up in the economy over the next couple months, which is going to be terrible. And, that could be a factor here. They're out looking for work. We know there really aren't that many jobs out there, particularly for higher income earners. And next thing we know, that all of a sudden what we should see, and I agree with you, the data is very clear. You can run this on a chart. I know you've done this. I've done it. It's so obvious. Where one goes, the other follows. But right now there's this gap. It's telling us, like you said, something doesn't add up. My hunch is that the people that are losing their jobs are the ones that aren't filed yet. I think the people that normally in a cycle lose their jobs at lower income, they immediately file. The higher income people, you get a severance, you get some walkaway package, you can't file right away. It shows up down the road.
Yeah, no, I thought that too, and I was, when we started to see unemployment rise in 2023, I thought, okay, there was a rash of layoffs at the end of 2022 into 2023. And there wasn't an immediate reaction to it. So, okay, the unemployment rate starts to rise in the middle of 2023, but jobless claims went up a little bit in the middle part, and then they improved while the unemployment rate didn't. So, yeah, I agree with you. There are definitely some white collar workers out there who are on severance and they're not filing for jobless unemployment insurance payments right away. But I think as time has gone on and the disparity between the two has only grown, it seems less and less likely. It seems more like there's a problem with the data collection in the survey itself or the seasonal adjustments in jobless claims than something in the real economy. I keep coming back to, because the unemployment rate is corroborated widely all over, I mean, pretty much everywhere. Even the Fed is cutting rates because, let's be honest, they know what's happening in the labor market. It's not like jobless claims. So it has to be something wrong with the jobless claims data, even though I have no idea what that might be.
Well, yeah, Jeff, and we know the Fed knows there's something wrong because the QCW came out, and that was a real shocker. I don't think anyone was really expecting it, even though the market largely ignored it. But we did hear Fed Chair Powell mention that because it came up during the press conference. Hey, what do you think of the labor market and these other factors? You cut 50 basis points. And Jeff, what I thought was really interesting, he really sold like the economy. Like, everything's just fine. Inflation's coming out. Can't you see the labor market? Can't you see we've done this? All in the meantime, in the background, everyone's scrambling around like, God, we got to cut rates because the fire's starting to burn here. And I think that's what he's afraid of, that everyone's going to figure out that he knows the labor market's in bad shape, that he really needs to cut rates, that maybe some magic will happen. Of course, you and I know no magic will happen, but he's just got to make it look really good. And there's something wrong. I don't know what it is, but he knows.
Yeah, he's mentioned the QCEW. We got to remember that the QCEW is way behind us here. They revised lower payrolls by 880,000 for last year. That was up through March of this year. That's not, I mean, we have no idea how much payrolls might be overstated more recently. So we look at the payroll numbers that have fallen pretty substantially over the last several months. And not only do we know that, the August number is going to be revised lower next month and the month after, we still have to keep in mind there's benchmark revisions coming next year that likely will make them look even worse, which is, again, another data point that suggests that jobless claims is an outlier, that it's not really or not representing what we see across a wider variety of macroeconomic statistics. So if that's the case, and this is right, Steve, this is an either or situation. This is not, okay, the unemployment rate can be okay and jobless claims is maybe there's some way to reconcile the two. It's one or the other, because the unemployment rate's moving up and the momentum is shifted to the point that it looks like a recession. It talks like a recession. It likely is a recession. And jobless claims are doing the opposite. So it can't really be, it has to be one or the other here.
Yeah, absolutely. And you see some bad decisions being made here by investors and the public and businesses based on bad information. And, I know Powell was asked, hey, what do you think of the non-farm payroll report getting the downward revisions and the QCW? And he quickly downplayed that as, yes, well, we know about this. And, well, we don't think the data is bad. We just know that going forward, when we see a number, it's probably going to come down a little bit. And he really suggested that, no, the data is accurate. And Jeff, as you know, he has to say that. He can't come out and say, hey, you know what? All this data is garbage, because they tell people we make policy based on the data. So you can't say that. But deep down, he knows Who knows? Maybe the non-farm payroll report is actually negative right now. We don't actually know. We won't find out till later, and he's hoping. Again, coming back to why did we do 50 basis points? It's simple. He knows things are bad. He may not know how bad they are, but he's hoping through some magic, cut rates, and maybe things will turn around and I can get out of this and look like a hero.
Well, Steve, we know for sure he doesn't believe the jobless claims number. That's for absolutely sure. Even if he doesn't believe the U.S. is in recession, I don't think he does. What he basically admitted by doing 50 basis point rate cut is that the risk is much higher than they had been saying all along. Of course, we know it's not just risk, it's actually happening. And that's really what this argument about jobless claims versus unemployment rate is about. One is jobless claims says there's no risk to the economy. Unemployment rate says it's not just a risk, it's actually happening. And the Federal Reserve in its 50 basis points is somewhere in the middle. And the markets are saying the Fed is going to shift further and further toward the unemployment rate. That's why rates are going to go down more rapidly. And even the Fed, I mean, I know you're going to laugh at this. We're going to bring up the dots. The dots are really stupid. They don't really tell you anything except what policymakers are thinking. Even the dots have shifted substantially over this last meeting, which means that, again, policymakers, even if they don't think we're in recession, they now believe that the risk is much, much higher. So they're not buying the jobless claim story. But let's talk about consumer prices for a minute. Let's talk about this negative change in new tenant rent, the new tenant rent index. And for those who are not familiar, the BLS in its CPI data collects a whole bunch of information, including shelter prices and market rents. Now, the vast majority of shelter prices are owner's equivalent rent, which is just a made up number that they put together from homeowners who they ask them, what would you be able to rent your house at if you were going to rent your house that you live in? But the market rent component, they break it down by different pieces, including something called new tenant rent, which is when new tenants, like the name implies, when people move from one place to another, they're actually accessing market information in the month that they move. So they strip out all the other people who are renting at that particular moment in time and just focus on those new tenants who are in the market and renting at that moment. So we get an idea of what the actual market for rents might be, and in a particular, actually it's quarterly, not a particular month, but by the quarter. And through the second quarter of this year, the BLS says that the new tenant rent index was down by a little bit over 1% on a 4-quarter basis for the first time since 2009. So in the monthly data, as I said in the intro, shelter prices accelerated the last couple of months, but the new tenant rent index suggests that shelter prices are going to be falling off a cliff. There's a huge disparity there too.
Oh yeah, and Jeff, when the CPI came out and I saw that tenant rents were going like, wait a minute, no, it's going the wrong direction. I know this is lower. I know this for a fact because not only do I rent and I see this, but around me there's just a ton of new buildings going up. We talked about this before the show, and when you rent, you get stuff in the mail all the time about, hey, new buildings coming up, and by the way, wouldn't you like to move here? We got a much bigger pool or all these fancy things, and oh, by the way, there's a big incentive for you to move. We'll give you a free month or two or this and that. And it really tells you that prices for new tenants are plunging. There's all of a sudden this massive amount of supply hitting the market. Now, I warned about this. I said, this is coming. And people said, no, you don't get it. There's a huge shortfall. I said, you've no idea. No idea how many buildings are going up. And the problem is once you have the building up, you've got to staff it. And you've got to pay on all the loans. And this is a big problem because you look at a lot of apartment complexes, who they're owned by, they've got big debts on these things, and they're variable rate debts, even worse. And a lot of these debts have been coming due at higher rates, and they're in trouble. And yes, there's an issue here. They need to get these buildings packed, but they don't have the people.
This is an artifact of the 2020, 2021, and first part of 2022, the commercial real estate bubble. Because these apartments that are coming up this year that you're seeing in Orlando and everywhere else, they were started a couple years ago because it takes a couple years to get a project, planned, funded, and everything going. So all the assumptions that went into these planned developments 2 years ago, they sure aren't panning out. So as the supply is coming online, the economy is falling off. This is in many ways another confirmation of not jobless claims, but the unemployment rate. So you've got this massive new supply that's hitting the marketplace. At the same time, demand is not there for it. And the only way to reconcile those two simple economic conditions is for prices to go down, which is exactly what the BLS is saying. That's what they're showing in that number. But the implications are not just, as Steve, as you're pointing out here, this is not just about, whether or not you can go rent a new place. This is about, can these projects service the debt that they have? Because they were expecting these places to fill up relatively quickly. They were expecting to receive income, and now they're crapping their pants, thinking, "Uh-oh, what do we do now?" Because we got all this debt and everything else. But there's a couple other implications too. Not only is there weak demand, what does that say about the economy? Also, the construction boom. The construction boom and construction jobs in particular have been one of the few sources of private economy strength over the last several years. With rents going down like this, builders are not going to want to build anything new. They're going to start laying off a lot of these construction workers because they have nothing left for them to do. They don't even have the ability to fill up the space that they built over the last couple of years. So there's quite a lot of macroeconomic implications beyond strictly what's going on in the CPI.
Oh, Jeff, it's far worse than you know. So I'll give you some really good examples. So I know some people who work at one of the places in the area who manages a bunch of complexes. They build them. They actually own them outright, which is the issue. They're laying off. Why? Because debt's coming due. They don't have the revenue. And here's the best part. They've got new projects coming. They don't have to fill them. Now I'll give you another one. The complex I'm in, all of a sudden after 2 years, all of a sudden things were getting fixed around here. They cleaned up and this was done and all. I'm like, so I asked, like, what's going on? Well, if you ask the right people, they said, oh, well, the owner, he needs money and he's trying to refi this. And the bank's telling him, look, you need to dress it up a bit. And I said, well, why does he need money so bad? They said, well, because after owning a bunch of complexes, he decided that he was really smart. And of course, you know where I'm going with this. So he said, because I'm so much smarter than everybody else, I'm going to start building some units. And he started building several of them. Well, guess what's happening? They're running behind. He's running out of money and the banks don't want to lend. There's a massive bubble going on in multifamily units. People don't even realize these companies are on the edge. There's only a matter of time before they start running out of money and these places go into delinquency.
Yeah, and I wonder if we're starting to see that too. It's not in the payroll report because construction jobs are still they're still going up. But I wonder if that's part of the unemployment rate where you have lack of hiring, because that's what's really been driving unemployment higher, is that some of these developers are saying, well, we were going to hire another couple crews to help us finish these projects that we got going, but now we don't need them because we're going to shut everything down. We're going to focus on the minimum. So when you look at everything we're talking about here, jobless claims, there is no corroboration for them. There's nothing that suggests that the labor market is in as good a shape as jobless claims make it seem. Same with consumer prices. Consumer prices have been highly disinflationary, except shelter. But the new tenant rent index, along with the anecdotes that Steve, you were just talking about, and you talk to anybody in the developer business, they say the same thing, that rents are coming down and coming down rapidly in a way we haven't seen since 2009. So that says nothing good about consumer prices, but also it tells you that the jobless claims number is not a reliable statistic. Instead, the economy, like the Fed knows and the Fed is worried about, is heading in the wrong direction, maybe quickly.